Welcome to the latest in Fitch's series of virtual investor meetings. I'm Kevin Degnan, Global Head of Structured Finance and Covered Bond Ratings. With me today is Grant Bailey, who heads our North America RMBS rating group. Welcome, Grant.
Thank you, Kevin.
Let's start with home price trends. It seems that most of the news of late has been positive. What's our outlook and how is that impacting things on the rating side?
The U.S. housing market looks pretty solid right now. So home prices have been going up about 5% each year the last couple of years, and most cities in the country have prices back at or above where they were 10 years ago prior to the crisis. And affordability still looks pretty good. So affordability based on historical standards is still very strong. Supply of new homes is still near historical lows. So the housing market looks like it's really well positioned to absorb a rise in interest rates if that's what happens. The home price recovery has translated into better mortgage performance, and the number of homes in foreclosure has really fallen. It's down to about a fifth of what it was at its peak in 2010. And that in turn has translated into thousands of rating upgrades on the legacy RMBS transactions, particularly in the subprime sector, where there are structures that allow for better rating recovery. The transactions issued recently, since 2010, have performed really well for a couple of reasons. The credit quality's been good. The credit enhancement and structure has been much better than it was prior to the crisis. And the housing environment has obviously been very supportive. So there have been hundreds of rating upgrades on classes issued since 2010.
Okay. Are there any hotspots that investors should be worried about?
Not too many, but there are a few. There are a couple in the Northwest. Portland and Seattle have seen home price increases of over 20% in the last 2 years, which is obviously unsustainable over a longer period of time. In the Southwest, Las Vegas and Phoenix have experienced very strong home price recoveries, but it looks like the momentum there has overshot a little bit recently. And the major cities in Texas look overpriced to us. And all of those areas appear to be about 10 to 15% overvalued, and we take that into consideration in our rating analysis.
Okay. Activity on the private label jumbo RMBS side has been rather muted for several years, but there seems to be growing interest in more of the off-the-run mortgage types, reperforming loans, non-performing loans, non-prime mortgage deals. Let's start with RPL. What's your outlook for that sector?
The seasoned performing and reperforming loan transactions, the volume there has been very strong. It's been about $15 billion a year the last couple of years. The composition of rated transactions has changed a little bit. More transactions are getting rated today, and the loans going into the rated transactions the credit profile has evolved a little bit to include loans that have had more recent performance problems. So there are fewer loans that have been clean for a long period of time. The offset to that is that those loans have more equity. They have lower loan to value. And because of that, the performance to date so far has been better than expected.
Okay, very good. And then how about on the non-prime side? What developments are we seeing there?
The non-prime RMBS sector is still small, but it's growing quickly. It looks like it's on pace to have about $3 billion in issuance this year. The credit quality of those transactions and the credit enhancement and structure is much better than it was pre-crisis. But Fitch has only participated in that sector selectively because the issuers, many of them have very limited track records, and other rating agencies have been more willing to rate those bonds at higher rating levels and with less credit enhancement.
Okay. And let's just go back for a second to the private label jumbo side. I mentioned that activity has been rather muted there for several years. Any reason to believe that things will improve in the second half of this year?
There's one notable development, and that is it looks like the participation of banks could be a little bit broader in the second half. Over the last 10 years, other than JP Morgan, banks have pretty much been absent from the prime jumbo RMBS sector. That could change for two reasons. One, banks are looking to expand their financing options, and securitization allows them to do that. And two, with the spreads tightening and with the yield curve flattening, the economics of securitization have improved a little bit and are a little bit more attractive. And because of that, I think we're going to see broader participation by banks in the second half of this year.
Okay, great. Thanks, Grant, for the update. If you have any questions about the topics we discussed today, please contact us at the email on the screen. Thanks for watching.